A balance sheet is a snapshot of a company's financial position at a point in time. It is built on the fundamental accounting equation: assets equals liabilities plus equity. Think of a seesaw. The left side assets must balance the right side claims on those assets. The layout follows a vertical or horizontal format. In the vertical layout, assets are listed first, usually in order of liquidity, followed by liabilities and then equity. In the horizontal format, the left column shows assets, and the right column splits into liabilities and equity, reinforcing the equation visually. The underlying engine is double-entry bookkeeping. Every transaction creates at least two entries, a debit and a credit, that keep the equation in balance. For example, buying a computer for cash debits equipment asset and credits cash asset. The total of debits equals total of credits, so the balance sheet stays balanced. Assets are divided into current, expected to be converted to cash or used up within 1 year, and non-current, used beyond 1 year. Current assets are like the items in a grocery basket you plan to eat soon: cash, marketable securities, accounts receivable, inventory. Non-current assets are like furniture in a house: property, plant, equipment, intangible assets. Historical cost records the asset at the purchase price, adjusted for depreciation or amortization. It is simple and objective, like noting the price you paid for a car. Fair value reflects the price that would be received if the asset were sold today, similar to the market price of a used car on a classified site. Depreciation spreads the cost of a tangible asset over its useful life. The straight line method: depreciation expense equals open parenthesis cost minus residual value close parenthesis divided by useful life. Example: a machine bought for $120,000, residual $20,000, life 5 years, results in $20,000 per year. Impairment occurs when the carrying amount exceeds the recoverable amount, which is the higher of fair value less costs to sell and value in use. The impairment loss equals carrying amount minus recoverable amount, and it is recognized immediately, reducing the asset's book value. Liabilities are also split into current due within 12 months and long-term payable after 12 months. Current liabilities are like your credit card bills, accounts payable, short-term loans, accrued expenses. Long-term liabilities are like a mortgage bonds, payable long-term debt. Accruals are expenses incurred but not yet paid, for example salaries earned by employees but not yet disbursed. Provisions are estimated liabilities for uncertain future outflows, for example warranty obligations. The amount is the best estimate of the future cash outflow discounted if the payment is far off. Contingent liabilities are possible obligations that depend on a future event, for example a lawsuit. They are disclosed in notes unless the probability and amount are measurable, in which case they are recognized. Amortized cost is used for financial liabilities measured at the effective interest rate method. The carrying amount equals initial amount plus or minus interest expense accrued minus cash repayments. This mirrors how a mortgage balance changes each month. Equity represents the owner's residual interest after liabilities are settled. Share capital: money raised from issuing shares, for example common stock, preferred stock. It is the seed money investors put in. Reserves: retained portions of profits earmarked for specific purposes, such as legal reserve, revaluation reserve, translation reserve. Think of it as a savings jar for future needs. Retained earnings: cumulative net income not paid as dividends. It grows when the firm earns profit and shrinks when dividends are paid. Treasury shares: own shares that the company has repurchased and holds. They reduce total equity because cash is spent to buy them back. Minority, non-controlling interest: the portion of equity belonging to shareholders who do not own the parent company in a consolidated group. Calculated as minority interest equals percentage of subsidiary owned by outsiders times subsidiary's net assets. All equity items appear after liabilities, and the total equity plus liabilities must equal total assets. When a parent company owns more than 50% of a subsidiary, a consolidated balance sheet combines the two entities, eliminating intra-group balances. Step 1. Add together like items, for example cash and inventory, of parent and subsidiary. Step 2. Eliminate intercompany transactions such as sales from parent to subsidiary, intercompany receivables and payables, and intragroup profits still embedded in inventory. This is like removing internal money transfers when two friends pool their bank accounts. Only the external balances matter. Step 3. Compute non-controlling interest. NCI equals 1 minus parent percent ownership times subsidiaries' net assets after adjustments. Step 4. Adjust equity. The parent's share of subsidiaries' net income is added to its retained earnings. The NCI share of net income is shown in the consolidated statement of changes in equity. The result is a single set of numbers that reflects the economic reality of the whole group, as if it were one company. Balance sheet numbers are not static. They are adjusted at period end to reflect reality. Revaluation of assets to fair value, for example, land revalued from $500,000 to $750,000. The entry, debit land $250,000, credit revaluation surplus equity $250,000. Write down for impairment, debit impairment loss income statement and credit the asset, for example, equipment. Equipment carrying $100,000, recoverable $70,000, resulting in a loss of $30,000. Reclassification moves items between current and non-current sections if their timing changes. For example, a loan due in 18 months reclassified from long-term to current. The entry, debit current portion of long-term debt, credit long-term debt. Adjustment entries from accruals. At year-end, salaries earned but unpaid are recorded. Debit salaries expense, credit salaries payable. Numerical example. Trial balance shows cash $20,000, accounts receivable $15,000, inventory $30,000, equipment $120,000 cost, accumulated depreciation $20,000, accounts payable $10,000, long-term debt $50,000, share capital $100,000, retained earnings $5,000. Adjustments, depreciation $10,000, impairment of inventory $5,000, salaries accrued $2,000. Adjusting entry depreciation. Debit depreciation expense $10,000, credit accumulated depreciation $10,000. Inventory write-down. Debit impairment loss $5,000, credit inventory $5,000. Salaries, debit salaries expense $2,000, credit salaries payable $2,000. After posting, the revised balance sheet reflects the new asset values and liabilities. Balance sheet-derived ratios help analysts assess liquidity, leverage, and efficiency. Current ratio equals current assets divided by current liabilities. It measures ability to pay short-term debts. 150,000 divided by 75,000 equals 2.0. Quick ratio acid test equals open parenthesis current assets minus inventory close parenthesis divided by current liabilities. It removes less liquid inventory. 150,000 minus 30,000 divided by 75,000 equals 1.6. Debt to equity D over E equals total liabilities divided by total equity. It shows financial leverage. 200,000 divided by 120,000 equals 1.67. Net working capital equals current assets minus current liabilities. Positive net working capital indicates excess short-term resources. 150,000 minus 75,000 equals 75,000. Return on assets equals net income divided by average total assets. It indicates how efficiently assets generate profit. Net income equals 12,000, beginning assets equal 190,000, ending assets equal 210,000, average equals 200,000, return on assets equals 12,000 divided by 200,000 equals 6%. For each ratio, show the formula, plug in numbers, and interpret the result. For example, a current ratio greater than 1.5 is generally comfortable. Preparing a balance sheet from a trial balance. List assets ordered by liquidity, then list liabilities with current first followed by long-term, then list equity items. Verify that total assets equals total liabilities plus equity. Identifying misclassifications. Spot items placed in the wrong section, for example, a 3-year loan listed as current. Explain the correction entry by reclassifying the portion due within 12 months. Computing working capital, subtract current liabilities from current assets. Show step-by-step calculation. Analyzing equity changes. Trace how net income, dividends, share issues, and treasury stock affect retained earnings and total equity. Consolidation problems. Provide steps. Combine balances, eliminate intercompany receivables and payables, calculate non-controlling interest, adjust for goodwill. Step 1. Sum like items. Step 2. Eliminate intercompany receivables and payables. Step 3. Compute non-controlling interest. Step 4. Present consolidated totals.